Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. The White House says 25% tariffs on Canada and Mexico will go into force at 12:01 Washington time. That's about 1 hour from now. Tariffs on China will double to 20%, in total hitting trade worth about $1.5 trillion. Donald Trump pauses all military aid to Ukraine, including weapons in transit, turning up the heat on Volodymyr Zelensky after their testy Oval Office meeting. Plus, China's top political advisory body meets in Beijing against a backdrop of escalating U.S. tariffs and sluggish domestic demand. We will bring you the preview. Well, everybody, it has just gone 8 a.m. across the Emirates. I'm Joanna Versace in Dubai, but perhaps today I should say it's not just 8 a.m. in the Emirates, it's 11 p.m. DC. Why? Because in about 1 hour's time, those tariffs are going to go into effect unless something happens in the next 59 minutes to change the course of where we're going. We will see higher tariffs on all imported goods to the U.S. from China, from Canada, and from Mexico. So markets are reacting to that. Yesterday, President Trump suggested that there had not been a last-minute agreement. And so we are actually in the very last minutes of these no tariff rates on Canadian and Mexican goods. That might change in the next 60 minutes. So on the back of that, we saw deep declines yesterday for S&P. The worst day of the year, actually, for the S&P. It ended almost 2% weaker. The NASDAQ down 2.5% as well. Risk-off sentiment really prevailing in the session. Today, what we're seeing is futures are leaning towards the green, marginally so, up 0.2%. The same for NASDAQ futures, up about 0.3%. But take a look at European futures. Yesterday, we actually did see a positive day on European markets, so bucking the trend with everything else. But, of course, the reaction there was very much to the defense spending announcements and what that could mean specifically for the defense sector and overall fiscal plans out of these European entities. But at the same time, today, once again, concerns around tariffs and the potential implement tariff on European goods is weighing on this market. Asia Pacific, the handover also being quite negative, down 0.5%. We'll get into that in a moment. But the bottom line is tariffs have not been good for market sentiment in the last 24 hours. Let's switch over, though, away from equities, just to give you the flavor for currency space, too. As not a surprise here, but you are seeing a weakening of the Canadian dollar versus the USD. We're about 0.2% weaker. And actually, we are down about 8% since where we were last September. So the Canadian dollar has been on a steady slide since it became apparent that Trump might win the election. Obviously, ever since the election and its talk of tariffs, that has been weakening the Canadian dollar. Mexican peso also down 0.5% today. But again, bigger picture, we're down about 18% over the course of the last 6 months. So still a lot of weakness transpiring over there. And then I also want to draw your attention to oil, not because of tariffs, because clearly that's a negative for global demand, but also we did get some headlines yesterday suggesting that OPEC Plus are on track to start putting extra barrels back to the market from Q2 of this year. And the question is whether the market is actually ready for that. We will be talking more about that on the show, but here's the reaction for Brent. Also bear in mind, throughout the course of the next couple of hours, we'll get earnings from Aramco too. So that's going to be another big driver for sentiment in that space. And then 10-year yields just reacting to global risk-off sentiment. We are down to 4.14. We're about 50 basis points lower in 3 weeks for 10-year yields. All right, let's pick up the conversation and check in on how markets in Asia are faring. Avril is in Singapore. Avril, what is the mood like today?
Oh, it's a bad mood, Jumana. We're seeing Asia stocks underwater. The region's benchmark earlier lost as much as around 1% to the lowest level in about a month. And this is as the pain on equities spreads to Asia. No thanks to those tariff concerns. What's that going to mean for global growth? But also that bad batch of U.S. economic data. So today, the Japanese benchmark is pretty much leading declines, almost 2% off. The losses are are exacerbated by the strength in the Japanese yen. Trump did single out the yuan and the yen, suggesting that he did not like them looking weak. What's also interesting is when you look at Chinese stocks, they've actually paired some of the declines from earlier in the session. This is the picture going into the lunch break. The Hang Seng actually declined about 2% earlier. So maybe there's an element of stimulus hopes helping to offset some of these tariff concerns, Jumana.
Yeah, let's not forget the NPC is happening the next couple of days. So we'll await and see what comes out of that. Avril Hong in Singapore. Now, President Trump is pushing ahead with tariffs on Canada and Mexico due to take effect in the next hour. The Canadian government has announced a sweeping package of counter tariffs, while Mexico's president has signaled she will wait and see what happens.
On the tariffs, is there any room left for Canada and Mexico to make a deal before midnight? And should we expect those Chinese tariffs, the extra 10%, to take effect tomorrow?
No room left for Mexico or for Canada. No, the tariffs, they're all set. They go into effect tomorrow. China also had an additional 10, so it's 10 plus 10.
We know that this is an existential threat to us, and there are thousands of jobs in Canada at stake. Now, we've done the work. We are ready should the U.S. decide to launch their trade war. We will be ready. We are not looking for this. We're not seeking this.
All right, let's bring in News Desk editor Jill Deeses for the latest. Jill, it feels like we're in some sort of a twilight zone between fantasy and reality, but of course, things actually may change in the next hour. What do we know about the scope of what exact goods are going to be covered by these new tariffs?
Yes, that's right, Jumana. So at this point, it seems that Trump is ready to go ahead with these pretty blanket tariffs covering 25% of all goods coming in from Canada and Mexico. The one exception there is Canadian energy. That would be hit with a 10% tariff instead. There were some concerns about Canadian oil kind of going into some of these initial discussions. But yes, I mean, we're looking at a pretty dramatic turnaround from where we were just a few years ago when Trump was, enjoying his first term in office, having negotiated sort of a successor to NAFTA and, created this new North American free trade agreement. And now, obviously, it looks like we're pretty much on the brink of a trade war with two of, the U.S.'s neighbors here.
Yeah, but it's not just one-sided. We've also had a response from Canada. So what does the retaliation from Canada look like so far?
Yes, that's right. So ultimately what Canada has put forth here is this idea of sort of a dual tranche of tariffs that they want to introduce. The first would be some 30 billion Canadian dollars worth of tariffs on, imports from the U.S. on things like orange juice. Peanuts is included in there. There's a few other items as well. And then there's a second tranche that what Canada is talking about where they would ultimately cover, things including aluminum, sort of big ticket items, cars, trucks, steel, that kind of thing. So it does seem that, Canada at least is prepared to hit back in some of those ways that they've found feasible. And then, obviously, as we've, heard on Mexico, still waiting to see what Mexico may ultimately do here. That response may come more during the sort of American morning hours here.
Yeah, and we were just putting up the numbers, the total volume of goods traded with Mexico and Canada. It's about $700 billion. So in total, these tariffs are going to hit $1.5 trillion worth of goods. That is a substantial figure. Bloomberg News Desk editor Jill Deeses, thank you for the analysis. Okay, let's pick up the conversation because fears surrounding this global trade war about the tariffs are rippling through markets. We saw a big pullback yesterday for the S&P. Joining us now is Deepak Mehra, Chief Economist at Commercial Bank of Dubai. What a day to have you with us on the show. First of all, do you think the market reaction yesterday was valid, given the pullback that we had for both S&P and NASDAQ?
Absolutely. I think the market is reacting the way we had expected. Actually, the markets can live with bad news, but they can't live with ambiguity and uncertainty. And with what's happening with tariffs today, whether one day you get it, next day they are postponed, and third day something else happens, you actually need an elaborate AI model to figure out how this will impact different industries, different sectors, different companies, different economies, their currencies. It's impossible for the human mind to possibly analyze or what's happening around us. So the first thing you do is you reduce your risk positions.
Let alone one person, President Trump, to be able to analyze all of the impacts. But that aside, do you have a view on who will come out, quote unquote, victorious from these trade wars?
I think right now, the U.S. has the upper hand. If you look at Mexico and Canada, about 14-15% of their GDP is exposed to exports to U.S. If you look at China, China is no longer in the same position as it was in 2018 when it was hit with tariffs by Trump in his first term. There are two things that have dramatically changed in China. Its economy is not doing so well. The domestic economy is under stress. And number two, it is more reliant on export than it was in 2018. In fact, export is the only engine for China, which is being hit by the U.S. So right now, the U.S. has the upper hand, and I think these partners will come to the negotiating table because they would want a deal.
But one thing that was interesting around the first trade wars, so under the first Trump presidency, is China ended up finding different markets to sell their products to. They could do the same this time around.
So last time around, they found different markets and started rerouting their exports to the U.S. So you saw how exports to Mexico went up, and then Mexico exports to the U.S. went up. So they were getting rerouted. I think Trump has his eye on that as well. And Mexico announced that they would be happy to put tariffs on Chinese goods. So I think it's not that straightforward this time around.
Is there anything that could come out of the NPC in the next few days that could change the narrative for China?
So the world is looking at that, and that is probably one of the biggest events of this week for me. Unfortunately, again, there are two issues that China is grappling with. One, if it goes for fiscal expansion, it has limited room over there. It has huge levels of debt at central government and at the state government levels. Then it has a deficit, which it is worried about. And if it goes for a monetary policy easing to promote consumption, it has a problem with weakening yuan and flight of capital. And if you look at the purpose, I think their key purpose would be to promote domestic consumption. But there, the consumers are already saddled with about $11 trillion of debt, mostly mortgages, where the property prices are coming down. So if you give them more money to spend, they're going to first deleverage rather than go out and spend.
Interesting.
So I think they are in a very big fix. They are in a bind.
Okay, so we've got the pullback in U.S. markets, a skepticism vis-a-vis China. Where do you see the bright spot? And is it Europe, given the outperformance of European equities this year?
I wish I could say that. European equities are up 13% this year, Euro stocks, after rising 17% last year. So a lot has been baked in Europe, thanks to the expectation that ECB will cut substantially and that, hopefully political situations will improve. And now, because of the Ukraine stuff coming squarely into Europe's plate, possibly it will lead to a revival of industrial complex within Europe. But I think a lot of that good news is already baked in with 2 years of fantastic returns in Europe. So how much upside is left, I doubt. So I think the safe haven trades right now is investors rushing into bonds. And you can see how 10-year Treasury yields have, for 7 consecutive weeks now,
it's impressive,
come down. So there's a massive bull run over there, rally over there. And that seems to be the risk of trade.
Okay. So do you think then, to tie it back to what you just said about fixed income, that the Fed will have to respond and be more aggressive with the cutting cycle then, in reaction to the impact that all of these tariffs and uncertainty is going to have on demand?
That is my base case. I think we'll get...
But it's contrary to what the market used to think, right? People used to think tariffs were inflationary and therefore the Fed would be cautious. But now I feel like the narrative has evolved.
It has evolved because what will happen with tariffs is this is a one-time price adjustment. This is not inflationary by itself.
It's like a VAT tax.
Exactly. So the Fed will want to look through that and be more worried about growth. So my base case is that we'll have rate cuts sooner than expected and possibly more than 2 as well.
Deepak, always good to chat to you. Thank you so much for sharing your views with us today. Big day for markets. Deepak Mehra, the Chief Economist at Commercial Bank of Dubai. Well, still ahead, China's top leadership begins key annual political meetings today to map out their latest economic revival plans. We're live in Beijing next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. President Trump's doubling of tariffs on China comes as the country's top political advisory body begins its week-long gathering. Bloomberg's China correspondent Min Min Lo joins us from Beijing. Really good to have you with us on site from Beijing, Noel. Min Min, let me just start off with the news of the day, which is that these tariffs and these additional 10% tariffs on Chinese goods are about to go into effect in about 45 minutes' time. How have Chinese authorities responded?
Well, early this morning, 9 a.m., as soon as the business day started, the Ministry of Commerce had put out a statement strongly opposing the additional 10% tariffs that are kicking in today, saying they will take all necessary measures to protect China's legitimate rights and interests, but they haven't spelled out exactly what those countermeasures are. So we are counting down to 45 minutes from now. I believe that's when we could hear from the Chinese government exactly what the countermeasures are. But according to Global Times, a state-linked tabloid, citing anonymous sources, they are saying that China could possibly target, for example, U.S. agricultural products. Remember that in the first trade war, soybean had been a target. Since then, China has really diversified its sources of imports, importing a lot from Brazil as well. But soybean, corn, wheat, these agricultural products are huge commodities that China buy in huge amounts, so they could be possibly at risk. There are other non-tariff measures that China could take as well, and that could look like export controls, putting certain U.S. companies on a blacklist. Micron has been in the firing line before, and maybe some of these companies China might choose based on this like-for-like retaliation given U.S. restrictions on the chips sector so far.
Yeah, so a whole different type of a range of responses that they could come out with. But how likely is it that we get an actual response during the course of the NPC that is beginning today? Many people are watching out for the NPC to get clues on how China are thinking about stimulating the economy. Could we get further action based on these tariffs that are due to come into effect?
Well, first of all, later today, I believe we'll get the countermeasures. As for whether the tariffs will actually figure into how China is thinking about its budget, some analysts say possibly not. The budget has been poured over for weeks and months, and some analysts are saying it's not even in the top 3 issues that policymakers are concerned about, given that China is likely already quite prepared for very high levels of tariffs of up to 60%. That was what President Trump had campaigned upon. And right now, top priority for the government, they have signaled before, is about boosting domestic consumption to build up the resilience of the economy so that they don't have to keep relying on exports for growth. And how they're going to do that is going to be the focus here. And to what extent is China going to focus more on a demand-side stimulus as opposed to going back to their old playbook of relying on investments and industrial policies to stimulate the economy? So we're looking out for the tone around that. Of course, people have been saying that this is a rubber stamp parliament where you don't really get a lot of debate. But the key is to listen for the principles and the tone and the signal of priority from the government in terms of what they're going to focus on, because we're not going to get specific measures. That's not what the NPC is for. It's about setting broad direction. That's what markets will be watching out for. And in the months and weeks following that, then local governments and various ministries will then be following up on the directives that are set during this NPC meeting.
Bloomberg's China correspondent Min Min Lo in Beijing for us today. Thank you so much. Now, coming up, oil extends losses near 3-month lows after a surprise hike in output by OPEC+. The latest on the world's most important commodity next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Well, the OPEC Plus alliance has announced an unexpected supply hike from next month. It's the first in a series of monthly increases to revive production that's been halted for more than 2 years. Let's bring in Bloomberg senior energy reporter Stephen Sichinski. Well, judging by the price action in energy markets yesterday, this did come as a bit of a surprise to markets, even though they had originally penciled in April 1st to start putting back barrels to the market. Why the decision now?
Well, I mean, look, the reason why it comes as a surprise is that over the last few years, you've seen OPEC Plus kind of kick this can down the road whenever you're in a market that is quite bearish. The IEA says that there's going to be an excess of 450,000 barrels a day in the oil market. So adding barrels would put more downward pressure on prices, and that's not something that would benefit producers like Saudi Arabia and others. Now, there could be a political element to this. Bloomberg reported overnight that the Trump administration had been putting pressure on OPEC Plus and Saudi Arabia to increase production. It's not much of a secret. Last month, Trump had said openly that he called on OPEC to reduce the price of oil. And this is the playbook that Trump used in his first term more than 4 years ago when he was pushing the same thing. He would push OPEC to kind of do his bidding, and it worked to certain degrees. Now, the reason why Trump wants this is he wants lower oil prices at home. Of course, that doesn't help American oil producers, but it does help American consumers at the pump, pushes down gasoline prices, and that's something that it's sort of a present that Trump has been wanting to push to consumers there.
Yeah, I've seen a couple of notes come through in reaction to it. Citi are saying that they expect Brent to drop to $60 to $65 over the next 6 to 12 months. Goldman have just put out a note saying they see downside risk to their own forecast of 78 to 83 Brent. So what is the likelihood that OPEC Plus can succeed at putting these extra barrels back to the market without causing the price of oil to drop significantly from where it's trading right now?
You know, it's not a lot that they can do per se. I think you have to look at, again, what Trump does and what Trump does maybe with Iran, for example. He's been putting a lot of pressure on Iran, and there are sanctions and measures to tighten Iranian exports as sort of a way for Trump to put more pressure on that country. If Iran is forced to reduce their output, that does provide a little bit more wiggle room for OPEC to kind of increase output from other countries. Likewise, what happens with Russia? Are they able to increase output? Are they able to increase output and sell their oil above the price cap that was implemented during the Biden administration? How does that affect prices and where things are in the market? And then likewise, there are things outside of OPEC's control. What do U.S. shale drillers do? What happens in Brazil? What happens elsewhere that could also affect the amount of supply coming into the market?
Yeah, all valid points. Stephen Sichinski, a Bloomberg senior energy reporter, thank you very much. Well, we're going to push on and talk more about those tariffs and the impact that they could have. Hear why S&P Global Ratings thinks the impacts of Trump's tariffs will be negative all around. Global Chief Economist Paul Gruenwald joins us next. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. The White House says 25% tariffs on Canada and Mexico will go into force at 12:01 Washington time. That is about half an hour from now. Tariffs on China will double to 20%, in total hitting trade worth about $1.5 trillion. Sliding further, oil extends losses after OPEC Plus announces a surprise increase in production from next month. Plus, Arab leaders are set to gather in Cairo for an emergency summit on Gaza, hoping to counter President Trump's controversial plan to take over the Strip. Well, it's just gone 8:30 a.m. across the Emirates. I'm Johanna Versace in Dubai. The clock is ticking. In about half an hour's time, goods imported from Canada, Mexico, and China into the U.S. will become just a little bit more expensive for the U.S. consumer. We're going to talk more about the ramifications from that and also what it means for the economy with S&P in just a few moments. But for markets, let me tell you, the reaction was pretty negative yesterday. We had the worst day for the S&P for all of 2025. S&P was down almost 2% in trading, NASDAQ down 2.5%. So risk off prevailing. Today, futures leaning towards the green, up about 0.3% respectively for the S&P and NASDAQ. Not the case for European futures. You can see behind me down 0.9%, despite the better price action that we saw there yesterday. Some momentum in European stocks, particularly in defense stocks, as we talk about the big fiscal plans surrounding a potential big defense package to come. But today, attention has once again moved on to the impact that tariffs could have on the European continent as well. Those are scheduled to go into effect in 1 month's time. So it's all about tariffs today. Asia Pacific, the handover from some of the Asian equity markets is also negative as well, down 0.3%. Let's flip over, because I also just want to walk you through the impact on currencies that we're seeing this morning. Not a surprise here, the Canadian dollar is trading weaker versus the USD. It's down about 8% since September and back to levels that we were at 1 month ago, when, remember, there was that 1 month reprieve that came in for the imposition of the tariffs. So we're now back to those levels again for the Canadian dollar. Mexican peso also broken through 20 to the dollar now, 0.5% weaker. And again, the theme for the Mexican peso has been one of weakness. We're down about 18% over the last 6 months. Now, Brent also in focus as well today, down 0.6% on that OPEC Plus announcement that they will start putting back extra barrels to the market from April the 1st. So from the second quarter onwards, we will see more supply coming from the OPEC Plus group. The market didn't seem to be ready for it, even though that was the original plan. This is the reaction in Brent today. And then 10-year yields continuing to slide. We are at 4.15 today, a 1 basis point lower, but again, massive rally in bonds over the past couple of weeks. All right, let's check in on how markets in Asia are faring. Avril is in our Singapore studio. The handover is not so pretty today. Avril.
Yeah, we are seeing declines across the board in Asia. The region's benchmark tracking Wall Street's losses after that bad batch of U.S. data, but also these tariff concerns really weighing. Japan is leading declines, and what is dragging the likes of the Nikkei, and includes the metals-related stocks as well as the automakers after Trump said for Canada, for Mexico, those tariffs are a go. Now, we are also seeing, interestingly, how the Japanese yen strength is kind of dragging the Nikkei, the topics further. And as our colleague Garfield Reynolds from the MLive team highlighted, Japanese stocks are among those that are correctly pricing in sort of or responding in a way from the U.S. launch of this trade war. But whether or not the declines on the Japanese stocks so far this year protect it from further downside, I think that's something that remains to be seen. Of course, for the yen, it got singled out by Trump along with the Chinese renminbi. He doesn't really like weakness in these currencies. Jumana.
Yes, Avril, thank you so much. Avril Hong in Singapore. Now, S&P Global Ratings believes the economic impacts of Trump's tariffs will be negative all around and may result in lower growth plus higher inflation and joblessness. Global Chief Economist Paul Gruenwald joins us for more on their research. Well, Paul, we were just walking through the price action in markets. It's been pretty negative the last 24 hours. Just talk us through what economic impacts S&P sees from the imposition of these tariffs on Canada, Mexico, and China.
Right. Hi, Jumana. Thanks for having me on the show. Well, as you mentioned, our view is that all around this is going to be negative. It's going to result in slower growth, higher unemployment and higher inflation, and the impacts will be asymmetric. So if we look at Canada and Mexico, which are obviously in the spotlight today, we see growth, or GDP rather, about 3% down in Mexico and 2% down in Canada. So these tariffs that are going to be put in place in about half an hour could potentially lead to recessions in both of those economies. The effects on the U.S. would be much lighter, maybe something like a 0.25% lower GDP, and roughly the same for China. So China and the U.S. are relatively large economies, but Canada and Mexico are smaller, and they're much more reliant on the U.S. for their exports than vice versa.
Okay, here's a question for you. Who actually bears the burden of the tariffs? Is it the exporting country or is it the consumers in the importing country?
Right, good question. Well, there's actually three candidates there. One is the exporting country; they could take a hit to margin. You could have the retailers in the home country take a hit to their margins, or they could pass it on to consumers. Most of the evidence from the last round and most of what we're assuming in the current round gets passed on to consumers in the home country. So I know there's been a lot of debate about this, but the evidence suggests that most of this gets borne by the country imposing the tariffs, the consumers in that country, and it's a kind of one-off bump to the price level. So it's inflationary on impact. The question is whether there's second-round effects after that, but it is the home country consumers that we think are going to bear the brunt of this.
Yeah, and of course, if there are secondary effects, then that is what central banks are going to be alert to in order to justify any response. But let me just ask you another question. President Trump, when he initially talked about tariffs and the imposition of tariffs, he also posited it as a revenue-raising measure. And the thinking for some is that these tariffs and the revenue generated from tariffs could help offset the tax cut increases, the extension of the tax cuts that are set to be discussed later on this year. Have you done any work as to how much revenue could be raised for the U.S. Treasury from the imposition of these tariffs and how much it could go to offsetting the tax cuts?
Yeah, we haven't published any specific numbers, but the view of the team is that it would be relatively minor. It's certainly not going to be in the magnitude of the trillions, which is where we're going with the extension of the tax cuts in the U.S. And also, if the tariffs work and they reduce imports, then the revenue from the tariffs is obviously going to go down. So you don't actually want success because that's going to dry up the revenue source. So we think that there's a kind of a modest offset, but you're not going to solve the fiscal problem in the U.S. By putting on tariffs. We don't think that's the right way to go.
What impact do you see for the U.S. dollar?
Yeah, well, there's this kind of two-phase thing we've been watching. So the initial phase, and you spoke about this earlier on the show, was that, folks thought this would be inflationary. So we saw the 10-year yields rise. We saw inflation expectations rise. We saw fewer rate cuts from the Fed this year. But what's happened over the last couple of weeks is we've had the uncertainty come into play. So the first kind of round of thinking was that this would be, at least on the margin, inflationary. But now we're starting to see some of the downside risk to growth from all the uncertainty around the tariffs. How long are they going to last? Are they put in place for trade reasons or illegal drug reasons or border control reasons or, defense spending reasons in the case of Europe? So there's just a lot of uncertainty. We've had a couple of bad prints on the U.S. nowcast that comes out of the Atlanta Fed. And all of a sudden, the thinking is the U.S. is now at risk of kind of scoring an own goal, to use a football analogy, where we started with a good economy this year, but all the uncertainty around tariffs and other policies could potentially hold firms and consumers from spending, and we could sort of work ourselves into a slowdown. So that's been pushing, bond yields lower and maybe putting Fed rate cuts back on the table.
Yeah, I saw that Atlanta Fed now. It's tracking minus 2.8%. That's a negative number, minus 2.8%. So to your point there, the data certainly started to turn. Final question just on China and how they may respond. We've got the MPC this week. Are we likely to see a big bazooka response out of Chinese authorities in not just response to these tariffs, but also just the general weakness that is still persisting in the Chinese economy, in some areas of the Chinese economy?
Right. Well, let me take those two separately. On the domestic stimulus, I don't think we're going to get the big bazooka. We've been waiting for a couple of years, and I spent a lot of time in Asia earlier in my career. The Chinese policy apparatus is really aimed toward boosting investment and boosting production. And what the Chinese economy really needs now is to boost the spending by households, which is still a very small portion of the Chinese economy. So we may get some incremental change coming out of the NPC, but I don't think it's going to be sort of the fireworks that are going to reignite growth. We've still got growth kind of 4 to 4.5% this year. On the tariffs, the Chinese have taken a pretty measured approach in the past, largely tit for for tat. And because of the trade imbalance, they don't have a lot of things to put tariffs on. You know, soybeans and airplanes are the two biggest imports from the U.S. So we would, we would kind of expect them to kind of shadow what the U.S. is doing. But again, given the size of the Chinese economy, it's much less trade dependent than it used to be. We've got a sort of a slight markdown for growth, but nothing on the order of what we talked about for Canada and Mexico. More like the U.S. and Europe, kind of maybe quarter percentage point of GDP.
Yeah. Yeah, ending up where we started. S&P Global Ratings, Global Chief Economist, Paul Gruenwald, thank you so much for joining us late from New York as well. We really appreciate it. Thank you. Now, Arab foreign ministers met in Cairo on Monday for talks focusing on Egypt's plan to rebuild the war-ravaged Gaza Strip. Egypt is hosting an emergency summit today where it's hoping to counter President Trump's proposal to expel Palestinians and take over Gaza. Joining us now is Bloomberg senior Middle East reporter Sam Daher. First of all, what exactly is on slate today with the summit?
Thank you. So today, I think Egypt primarily would be, and the Arab League would be looking to get broad backing from the leaders meeting at the summit for this plan. I mean, it's being called an Egyptian plan. Egypt is calling it an Egyptian Arab Islamic plan. We've spoken to people who've seen it, who've been briefed on it, and they say it's about 150 pages. It talks about temporary housing for Palestinians while rubble removal is underway. There's Hamas. It doesn't spell it out, but Hamas will not be involved in the day-to-day running of the affairs of Gaza. A committee of notables, and it's an administrative committee of notables and local functionaries. It's going to be running Gaza, and it will be overseen by representatives of Arab states. It will be in phases and tied to the establishment of it has a political dimension tied to the establishment of a Palestinian state.
Yeah, I mean, this is essentially the counter-proposal to Trump's so-called Gaza plan. He said, well, show us the alternative. So this is the opportunity for Arab states to come out with their alternative. What are some of the challenges that they're going to be facing?
Absolutely. I mean, first of all, you've got the ceasefire. If it completely collapses, then this plan is moot. The Egyptian foreign minister, Badr Abdelati, said that they will be meeting in Saudi Arabia this month to iron out a lot of the details and differences. He didn't say differences, but said details. He said they would travel to world capitals to rally support for this plan, and that would include Washington, D.C. According to the people we've spoken to, there are some major sticking points that still need to be resolved before they take it to President Trump. While there is some consensus that the top military leadership of Hamas will have to be removed from Gaza, there are differences. The plan doesn't spell out the dismantling of Hamas, the disarming of Hamas. Some countries feel that you will have to deal with so-called moderate elements of Hamas, and that's a non-starter for Israel, as we know. Other countries are a bit more uncompromising. Also, countries like the United Arab Emirates have issues with the current Palestinian Authority. They want a complete overhaul of the Palestinian Authority before they commit funds. And then the biggest question is, who's going to pay for this? I mean, the bill is like $50 billion. Those are the estimates.
Wow.
And Arab countries have come out openly and said they will not put a dime in long-term reconstruction unless there's a long-term political solution, which is Palestinian statehood. And as we know, Israel rejects that, and we don't know where President Trump stands on that.
Yeah, okay. Well, still many hurdles to get through. Sam, your full story is coming out on the terminal in about half an hour's time, so I look forward to reading it, and I would direct viewers to that article as well in half an hour. That was Sam Daher, Bloomberg's senior Middle East reporter. Now, coming up, just days after his explosive meeting with Ukrainian President Zelensky, Trump has now paused all military aid to Ukraine. The details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersachi in Dubai. Well, we are about 15 minutes away, even less, from the imposition of those tariffs, additional 10% tariffs on China, in addition to those 25% tariffs on Canada and Mexico. We've just got a few lines coming through from the NPC's Lou. So he was asked about the U.S. tariffs in the press briefing. He says he hopes China and the U.S. can find solutions through consultations. China will work with other countries to safeguard the trade system. But then he also says China definitely doesn't accept suppression and threats. So that is just coming through now. This is from the NPC spokesperson who has been outlining the agenda for the NPC that kicks off formally tomorrow. So this is what we're witnessing right now. Some of the lines coming through. China definitely does not accept suppression and threats. So we're going to keep an eye on further comments coming through from China in response to these tariffs, which are about to get imposed in about 14 minutes' time. Well, let's move on. A senior U.S. defense official says President Trump has ordered a pause to all military aid to Ukraine. The move turns up the heat on Volodymyr Zelensky days after an Oval Office blow-up with the Ukrainian president left support from his country's most important ally in doubt. Joining us now is Bloomberg senior reporter Henry Meyer. Henry, so this is a big decision out of the U.S. They decided to halt or temporarily halt military aid to Ukraine. What does President Trump want to see?
Well, I mean, this decision is a huge shock, of course. I mean, we had been anticipating that President Trump would pause further assistance, but we're talking about here is $3.85 billion of military assistance that had already been approved under the previous administration. And, anything which is currently on its way to Ukraine will also not be delivered. What he's, trying to achieve here clearly is to force President Zelensky to beat a retreat, essentially to make an apology for what happened at the Oval Office on Friday and commit to a peace agreement. So far, the Ukrainian leadership has been very reluctant to go down that path. And in his latest comments, President Zelensky made it clear that he thinks that a peace agreement is a long way off. That appears to have been also what triggered this latest action by the United States. I think we're going to see probably now frantic diplomacy by European countries, allies of Ukraine, which are going to be trying to diffuse the situation, which is getting far worse now.
Can Ukraine continue to operate in this war? Can the war continue in the absence of U.S. military support?
I mean, this is the big question. Clearly, it can continue for some time, and they will be getting alternative supplies from Europe. But the ammunition that they rely on mainly comes from the U.S. I mean, even before this decision, there were forecasts that without fresh military assistance from the United States, that Ukraine would run out of sufficient supplies by the summer. Now, with the aid that was supposed to be delivered in the coming weeks and months, also on pause, what could happen is, of course, they will continue fighting, but the Russians will be able to exploit that weakness. They've been trying to move forward to capture more territory, and that campaign will accelerate, which, of course, will further weaken the Ukrainian position in these talks.
Very clear. Bloomberg senior reporter Henry Meyer giving us the latest on what's been happening with Ukraine after that Trump decision to pause military aid. Now, coming up, the UN's food agency is shutting its South African hub amid Donald Trump's aid cuts. We're live in Johannesburg with the latest next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersachi in Dubai. The United Nations World Food Programme is closing its Southern African bureau as it expects funding from donors such as the U.S. to slump by 2/5. The closure comes as 26 million people in the region face food shortages ahead of this year's harvest. For more, let's go to Bloomberg's Anthony Skazin in Johannesburg. Anthony, what do we know about this decision?
Well, the staff here in the Johannesburg Bureau were told on Friday evening that the bureau would be closed. They had been given some indication the day before when the deputy director of the WFP visited. And what we've been told is that in a speech to staff, he said that massive cuts would be needed at the agency, and it was mainly due to the pullback in aid from the US and also due to European countries cutting their aid budgets.
What impact do you think it will have on operations in the region?
Well, Cindy McCain, the director of the WFP, in a letter to staff said that Southern Africa would remain a priority. But it's staff that we've spoken to indicate that that's going to be quite difficult. The hub in South Africa is one of the biggest procurement hubs. It buys hundreds of thousands of tons of grain every year and ships that to needy countries in Southern Africa. So it's going to have quite an impact because there is not going to be much grain on the ground until May, when the next harvest comes in. Now, the harvest, the current shortage is caused by last year's drought, which decimated the harvest, but in some countries like Zimbabwe by up to 70%. So it's hit. This decision has hit the region in the worst possible time, what's called the lean season. The 2 or 3 months before the harvest when supplies are the lowest, the supplies from last year. So it's going to be more difficult for the WFP to roll out its relief efforts. It's come at a bad time, and a lot of the countries here are already struggling to finance an adequate response, and it's causing a lot of hunger and discomfort for the citizens of these countries.
Yeah, clearly going to have some significant ramifications on people in the continent and beyond. Bloomberg's Anthony Sugazan, thank you so much, live from Johannesburg. Well, we are about 3.5 minutes away from those tariffs being imposed on Canada, Mexico, and the additional 10% tariffs on China. This is what the markets look like. Equity futures actually pairing some of the losses from yesterday, leaning towards the green, up 15 basis points for the S&P, Nasdaq up 0.3%. But take a look at Eurostoxx futures, leading towards a very, very weak open, down 1% after a better close yesterday. So this is the picture. We'll be back in the next hour talking more about tariffs and beyond. Andrew Freris from Ecognosis Advisory joins us to talk about the market reaction. We'll be back. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. The White House says 25% tariffs on Canada and Mexico will go into force at 12:01 Washington time. That is just seconds away. Tariffs on China will double to 20%, in total hitting trade worth about $1.5 trillion. Donald Trump pauses all military aid to Ukraine, including weapons in transit, turning up the heat on Volodymyr Zelensky after their testy Oval Office meeting. Plus, China's top political advisory body meets in Beijing against a backdrop of escalating U.S. tariffs and sluggish domestic demand. We will bring you the preview. Well, good morning, everybody. It's just gone 9 a.m. across the Emirates. I'm Johanna Bersetchi in Dubai, but crucially, Jan, it is not only 9 a.m. in the Emirates, it is just past 12. It's after midnight in D.C., and you know what that means? That means those tariffs have gone into effect. The Trump tariffs on Canada, Mexico, and China are now technically in effect. And just as a reminder to our audience, that is a 25% tariff rate on Canadian and Mexican goods. There is a carve-out specifically for Canadian oil. That is just a tariff rate of 10%. But then on China, we're also looking at an additional 10% in addition to the 10% that already existed. So a doubling essentially to 20%. That is the total tariff rate. Now, we're also getting some responses coming through from China as well. Right now, at the same moment, China are saying that they too will start levying some tariffs on some U.S. agricultural products. China also saying that they will impose up to 15% tariff on some U.S. goods. So this is what we are getting right now because the deadline has just hit. More commentary coming through from China as well. China to levy tariffs on some U.S. products, including on soybean. And they've also added 10 U.S. firms to the unreliable entity list. This is a commentary coming through from China now. They're also levying tariffs on some U.S. products, including sorghum as well. So all this has happened in just the last couple of minutes. Just to recap, these Trump tariffs on Mexico, on Canada, and on China have now gone into effect. So they are being implemented. At the same time, we have got the counter response from China. China are now saying that they are also applying their own tariffs on U.S. agricultural products. One step further, China also saying they will be filing a lawsuit to the WTO over these U.S. additional tariffs. So we are going to keep a close eye on all of the announcements coming through from both China and the U.S. And of course, earlier on, we heard from Canada as well, who will be retaliating on, they say, of just above $100 billion worth of U.S. goods in two-step measures. Yet to hear from Mexico that should be coming at some point. But this is the response from China this morning. The reaction in markets, let's take a look at S&P futures and NASDAQ futures and how they're trading actually in the green after a big sell-off yesterday. We saw the worst close for the S&P for all of 2025 yesterday. The index was down 1.8%. NASDAQ ended the session down 2.6%. Today, recouping some of those losses and actually trading up in the green, 0.2 and 0.4%, respectively. Not the case for European futures. And of course, that tariff decision is in 1 month's time. So we've got another 30 days to wait before the tariff decision on Europe takes place. But there is a lot of fear there about what that could mean for the European economy. That is why you're getting a negative reaction for Euro stocks today, down 0.8%, despite the better close yesterday. And then Asia Pacific, no surprise really, but the handover from Asian stocks is also pretty negative as well. As for currencies, let's take a look at the reaction in the Canadian dollar. Some weakness coming through. We're about 0.1% weaker versus the USD. Of course, a lot of this was priced in, but we are now back to levels of where we were a month ago. Once the decision to impose tariffs was delayed by a month, there was a 1-month reprieve. We're now back to those levels again for the Canadian dollar. Mexican peso also cheaper versus the USD this morning to the tune of 0.5%. Remember, the Mexican peso is about 20% weaker just in the last 6 months as well in anticipation of these tariffs. Brent also in focus. Tariffs, clearly one of the factors contributing. But then we also had the OPEC Plus decision. They have said that they're going to start increasing production again from the beginning of April. So that's why you're seeing that downward push on the energy complex this morning. And then 10-year yields in response to this global risk-off sentiment continue to march lower. We've been talking about some of the momentum in the U.S. economy beginning to peter out. That Atlanta GDP now forecast at minus 2.6%. All of that is contributing to the lower yield levels that we are witnessing. But let's go back to the Asian markets story and the fact that China have now responded. China have retaliated against these Trump tariffs with levies of up to 15% on some U.S. goods, including agricultural goods. Avril Hong is in our Singapore studio with a reaction. Avril.
Yeah, Jumana, it's really interesting across Chinese assets. They are not really responding in the way you would expect with the start of a trade war and tit-for-tat measures. You just broke down what China has done in response. You look at the Chinese stock gauges, the CSI 300, as has the Hang Seng, both pairing declines from earlier in the session. Hang Seng earlier in the day, 2% down. Now, some of this might be traders looking ahead to the NPC stimulus hopes, but I think it also gives you a sense that maybe there is a more measured response that still can be expected between the two sides. There is also a bit of a disconnect when it comes to the FX space, because you look at the offshore renminbi and the Aussie. These are two currencies that usually move in tandem. Today, they're moving in different directions. Of course, some of this might have to do with Trump singling out the renminbi as well as the yen in a way, saying he doesn't really like the way China and Japan weakens their currencies as it benefits their trade. But as Garfield Reynolds of the MLive team also very astutely pointed out, it gives you a sense of how Trump's tariffs is spreading volatility across even FX markets. Jumana.
Yep, clearly having an impact across all markets today. Avril Hong in Singapore. Now let's get out to Bloomberg's Asia senior editor, Bill Freris, who joins us for the latest on these Trump tariffs, which have just taken effect in the last 6 minutes. And we have instantly got this response out of China saying that they also will be looking to impose retaliatory tariffs on some U.S. agricultural goods, including soybeans, and applying levies of up to 15%. Bill, it feels like we are very much now in the midst of a trade war.
Yeah, absolutely. I mean, Donald Trump was talking about this throughout his campaign. He even told Bloomberg in a speech or an address that, tariff was his favorite word. I think there were some questions whether he would really go through with these measures or whether they were just negotiating tactics. It looks like they are not just negotiating tactics at this point. They are a means to a further end for him. With tariffs coming on China as well as Canada and Mexico. And remember, Canada and Mexico, that's a trade deal that he negotiated during his first term that he really had nothing but high praise for. So now he's critical of how that trade relationship has come through. And we're seeing the hit now to well over $1 trillion of goods and possible escalation coming in the weeks and the days, weeks, and months ahead here.
What potential is there for a back down on all sides here? And I know that it seems a bit paradoxical to ask that question because we just got the counter tariffs from China. Earlier, we heard from Canada as well and what they're going to be doing to respond to these tariffs. But what is the likelihood that a window opens up in the coming hours, in the coming days, for all of these sides to back down from the tariff imposition, or at least a sustained tariff imposition?
Yeah, I mean, it's certainly a possibility with Donald Trump. He loves to make a deal, and this may be him just kind of putting the hammer down and saying, okay, let's find a way to work through it, whether it's an issue of fentanyl or illegal immigration, or whether it's something like the broad trade deficit with China. So it's certainly always a possibility. I think Mexico was pushing hard to have this staved off a bit when they sent almost 36 drug cartel leaders to the United States to face charges there. But, I think ultimately his goal has been to narrow these trade deficits, particularly with countries like China. I don't think unless the stock market or the U.S. economy push back with a lot of pressure, and that's something we may see in inflation numbers in the weeks and months ahead. We've already seen some slowdown in economic activity. That's the kind of pressure I think that Donald Trump will respond to over perhaps the political condemnation he's getting now.
Yeah, absolutely, Bill. And earlier on, we were speaking to the S&P head of global economics, and he was saying that he expects the economic impact to be very sizable for Mexico and Canada, 2 to 3%, for U.S. and China, something like 0.5 percentage point, but then also for the impact to be inflationary. So you heard it from an economist as well. Bloomberg's Asia senior editor, Bill Freris, thank you so much. Now, fears surrounding a global trade war as Trump's tariffs take effect are rippling through markets. Joining us now is Andrew Freris, CEO at Ecognosis Advisory. Well, Andrew, it finally happened. These tariffs have actually gone into effect. There was a lot of talk, but now there actually is action. Markets so far seem pretty muted as far as the futures are trading. What do you see as the path forward for markets from here onwards?
Actually, I'm absolutely nonplussed with the degree of, quantitative ignorance in the market as to what these things imply. Look, let's take China. Okay, exports from China in the year 23-24, exports from China to the United States accounted for about 3% of GDP. 3% of GDP. Suppose the tariffs cut these exports by, let's say, 10%. I just use the same number. That is 1/3 of GDP. In other words, the impact on China is going to be absolutely minimal, if not nothing. So we are spending a lot of time tearing our hair and saying, good God, there is a war. Incidentally, there isn't a trade war. Is China imposing tariffs on Japan? No. Is Brazil imposing tariffs on South Korea? No. Is Philippines imposing tariffs on Greece? No. So where is the trade war? The trade war is between the United States and the rest of us. That's not a trade war. That's a unilateral assault. Now, the fact that some countries are responding, it would be very nice if they simply said, thanks very much, we'll take those tariffs in our stride and we'll come back to you later on. Don't call us, we'll call you.
Yeah. Okay, I take your point, but number one is the U.S. is the largest economy in the world, so you can't ignore what the largest economy in the world is doing. And number two, it creates an environment of uncertainty.
Yes, you can.
Why do you think you can?
You can. United States accounts for 11% of world trade. That was the figures for 83. Let's say even double that, or not double that, increase that to 15%. The other 85% is not trade with United States. So why we are obsessively concerned with the 13 or 15% and we'll completely forget the other 85. We can easily trade amongst ourselves and ignore United States. You know, the God always and the devil is in the details. One once begins to look at the details, it begins to look such an exaggerated obsession with the importance of the United States. Yeah, it is the biggest economy, okay, and it accounts 11% for the world trade. Well, so I will be slightly nonplussed over that. And actually, I am.
Yeah. Yeah, well, actually, you know, it's interesting what you're saying because, like, if you look at the reaction today, some of these Chinese tech stocks, for example, have fully paired the losses. We're actually trading positive on the day, a case of buy the rumor, sell the fact, and we've pulled it up there. There were losses of as steep as -4% at one point. We're now back positive on the day. Let me just ask you then, Andrew, given the narrative that you just prescribed to us, where do you see investment opportunities then, if not in the U.S.?
I see investment opportunities first on pure sectors, and I'm afraid I have a terrible reputation of loving defense stocks, and they are doing great right now in Europe, not so well in the United States. Because the Europeans are saying, okay, the United States doesn't want to sell us guns, we will produce them ourselves. And the European defense sector is enormous, as is the ones in Asia. So I see a great degree of opportunity in buying non-American guns, in inverted commas, for the time being. For the time being, I emphasize that. The second part is to take economies such as India, which is also effectively export taxes immune, because in India, the exports imply a very small percentage of GDP, whereas the domestic market is enormous, as in fact is in China. So the opportunities, surprisingly enough, if one is obsessed about how all these things is going to affect everybody else, is to look where exports do not matter in terms of GDP. And one of them is China, and the other one is India. China, however, right now is not doing very well because of deflation, and we're going to have some potential measures being taken next week. So I will hold back on this little bit, and I'm starting to get in more and more, let's say, interested as the process of this obsession with American tariffs develop, to say, okay, which countries are not going to be affected primarily by US tariffs, and go to them. So one of them is China and the other one is India. And the sectoral part, it's very bad, guns.
Defense, yeah. Well, I was looking at this yesterday, actually. European defense stocks up 60% year to date. Who would have thought? Well, maybe you did. Ecognosis Advisory CEO Andrew Freris, thank you so much for joining our show today. We appreciate it. Well, still ahead, Israeli media is reporting Israel is planning to resume its Gaza offensive in 10 days if the impasse with Hamas continues. The details next. This is Bloomberg.
Welcome back to Horizons Middle East and Africa. I'm Jennifer Zapasaja in Johannesburg. Israeli media is reporting Israel is planning to resume its Gaza offensive in 10 days if the impasse with Hamas over a new truce proposal persists. A 6-week initial ceasefire expired on Sunday without the parties agreeing on terms for a proposed open-ended extension. Hamas says it's still committed to the ceasefire and that extending phase 1 and other suggestions are not consistent with the original agreement. Let's go to Jerusalem now and speak to Bloomberg's Dan Williams, who has been following this story. Dan, what do we make of this new proposal from Israel and also what we're hearing from Hamas?
Well, it's hard to know what to make of that leak to Israel's top television channel yesterday. It hasn't been officially confirmed that Israel has a date when it plans to go to war, and indeed, that would seem counter to basic operational secrecy. On the other hand, it wouldn't be surprising. The ceasefire, as you noted, this initial ceasefire that was agreed by the side, lapsed as scheduled on Sunday without an agreement on extending it into an open-ended, effectively an end to the war. So all bets would appear to be off, and Israel is determined to achieve its war goals, chiefly the return of dozens of hostages still held in Gaza. Now, Hamas appears to be trying to buy time by saying it's still open to talks. However, it's really not clear what those talks would be about. A second phase of this envisaged deal would effectively end the war. Israel has made clear, and it has U.S. support for that, that the end of the war has to also mean the end of Hamas in the Gaza Strip. Hamas has given no indication it would go along with that. The negotiations have already been done in public, going well back. So we would appear to be at an impasse, and Israel appears to be weighing all its options and taking its time.
All right, we will leave it there. That's Bloomberg's Dan Williams in Jerusalem for us. Dan, thank you so much for your time and for your reporting. Now, still ahead, China begins key annual political meetings today as Beijing maps out its latest economic revival plans. We're live in Beijing coming up. This is Bloomberg.
Welcome back to Horizons Middle East and Africa. I'm Johanna Versace in Dubai. A busy day of news today. Austrian energy producer OMV has agreed on key terms with the UAE's Adnoc to create a $60 billion global chemicals and plastics giant following 2 years of negotiations. Now, I spoke to OMV CEO in Davos while the companies were still negotiating.
We are in negotiations with Adnoc for a potential merger of Borealis and Borouge, because that would create a global polyolefins player of bigger dimensions. And with this, this would be an acceleration of our strategy.
Okay, let's talk more about this and get out to Bloomberg's Anthony De Paula. What we were talking about the potential merger of these two units. I spoke to the OMV CEO, and he said that the plans or discussions were on track to create this global player. What has been the result of the talks?
Yeah, so they've agreed on the terms now, and so it's been kind of a, you might almost say, a tortured negotiation since about summer of 2023, at least almost 2 years that they've been in talks. There have been issues around valuation, around where the unit might be based or listed, and of course we've had Austrian elections in the meantime, so the government, which controls the stake there, needed to come in and decide. So what they've agreed on is, as you said, a company that will eventually be worth about $60 billion, they say. That includes the acquisition of Nova Chemicals in Canada. They're going to bring a new plant that Borouge is building here in Abu Dhabi into that. And basically this is taking the mainly European-based Borealis, in which both Adnoc and OMV have stakes, and they're going to be merging that with Borouge, which is listed here in Abu Dhabi. Those are both big chemical companies, and these companies are really targeting the ability to make plastics, packaging, those kind of things that are going to car batteries, mobile phones, computers, those kind of things that we will continue to be using as consumer products.
And how does this merger or deal serve Adnoc's strategic interests?
As I said, they want to get into that chemical business because they see that demand for those consumer products going ahead in the future. They kind of want to get out of selling oil for transport, because as we get into the energy transition, because that is going along despite some hiccups now, as we stop using so much oil and gas for transport, we will be using more of that in the chemicals and those kind of consumer goods. And it's a way that they can also see it being able to capture more of those carbon emissions and so kind of lower the carbon footprint. So they see this as kind of a somewhat greener, a somewhat newer kind of business that they want to get in, and they see that demand growing even more than transport and fuels going forward. So it's really protecting the company's future.
But the deal is still not done because it still needs to get final sign-off, right, from the OMV board.
Yeah, so all these deals, the OMV board needs to sign off. They'll need regulatory approvals, and they'll just need to make sure that there's no antitrust issues in any of those markets that they're getting in. But we should also say that this looks to future growth. They're going to do future acquisitions with this, and Adnoc is going to put its shares into its company XRG, which is that new investment fund that they're starting to expand globally. So a lot more to come from this story.
Yeah, it certainly appears to be the case, and one to watch. Anthony, thank you so much. And we're going to have you on later talking through Aramco earnings, so stay tuned for that as well. Anthony will be back. Okay, TSMC, the world's top producer of AI chips, says it will invest an additional $100 billion in U.S. plants, supporting President Trump's goal of increasing domestic manufacturing. The chief executive of Taiwan Semiconductor joined Trump at the White House to unveil the plan, which marks one of the largest outlays by a foreign firm in U.S. manufacturing. The investment will bring TSMC's American presence to a half dozen plants for advanced wafer fabrication. So another company looking to invest in the U.S. This is how futures are shaping up. A lot of green for U.S. futures. Euro Stoxx futures down 0.75%. Buy the rumors, sell the fact. The tariffs have been imposed on Canada, Mexico, and China. We'll be talking more about that on the show. But coming up, we'll also be talking about Africa's main stock exchange, who reported results for 2024.
Middle East and Africa, our top stories this morning. 25% U.S. tariffs on Canada and Mexico take effect, with Chinese imports hit by 20% levies. Beijing immediately fired back, targeting U.S. food imports. Canada also retaliates. Sliding further, oil extends losses after OPEC Plus announces a surprise increase in production from next month. And we'll focus on earnings out of South Africa. We'll bring you interviews with the CEOs of both Nedbank and the Johannesburg Stock Exchange in just a few minutes. But for right now, it has just gone past 7:30 a.m. in South Africa. I'm Jennifer Zabasaja in Johannesburg.
And I'm Johanna Versace in Dubai, where it's just gone 9:30 a.m. Welcome to Horizons Middle East and Africa. So much news to piece through today, but of course, the main headline, Jen, is that these tariffs have actually now formally been imposed. The U.S. has applied tariffs on goods from Canada and Mexico and China as well.
Yeah, the day that many people were waiting for, actually, to see whether it would come. We're seeing that play out. But as our MLive colleague Mark Cranfield points out, a little bit of stride that we're seeing, at least some assets taking right now. If we just take a look at futures right now for U.S. equity futures, up just about 0.3%. But that is notable, of course, because a Monday was the worst day in 2025 for the S&P index, closing about 1.8% lower. And of course, a lot of the worst performers were tech and also energy. And the question is, what will the action be when U.S. trading opens later today? Of course, now that we are seeing these tariffs now being imposed. And we're also seeing the S&P more than reversing all of its gains since Trump's inauguration earlier this year. But let's get back to the main story, which is that tariff pressure. The tariff pressure really feeding through into currencies. Although, as we mentioned, not too much action right now, although we can see the Mexican peso and the Canadian dollar weakening slightly against the dollar right now. The Mexican peso down almost 0.4%. But the question again will be, what do these retaliatory tariffs mean for the currencies, and how does that then feed into the story more broadly? Also, we mentioned this at the top of the show. The energy story right now is part of the energy story is playing out in crude after we got that decision from OPEC Plus to revive halted production after a lot of the pressure that the bloc got from President Trump. So now we're seeing Brent down almost 0.8%. And let's just get to that, the tariff talk and the tariff uncertainty, because, of course, it is President Trump's favorite word. But it's also really confusing a number of investors, as this chart is showing. This is a chart from a survey done by Baker, Bloom and Davis, illustrating just how much uncertainty is feeding into investors. It's actually at a record high. And a lot of the uncertainty and certain questions that investors are having right now. It's about demand. It's about what price to actually set and how much to purchase. And so, again, we're going to watch closely how this continues to play out through the trading day, especially when markets open in the U.S. But let's check in on how markets in Asia are faring. It's been a few hours there now, just a half hour, though, for the tariffs to actually set in. Avril, give us a sense of what you're watching.
Yeah, I mean, the tariffs kicked in top of the hour. We've seen China already responding. But if you look at Chinese assets, they're kind of confounding expectations, not really reacting in a way you think with the start of a trade war. And that's being leveled by the U.S. China responds as well. Some have pointed out that when you look at these pairing of earlier declines on the Chinese gauges, maybe there's a bit of buy the rumor, sell the fact underway. Maybe also that some had expected a lot worse when it came to China's retaliatory action. Flip the board, I think the disconnect is also being reflected in other asset classes. For example, if you look at the renminbi's climb today, yes, it paired a bit of the earlier gains after the tariffs kicked in and we saw retaliatory action, but it is suddenly moving in a different direction from the Aussie, which, of course, as we know, they are closely correlated. So this might have something to do with Trump talking about, how he doesn't really like the weakness in the currencies of China and Japan because it helps their trade. But it also tells you how this spreading of volatility is underway because of Trump's tariffs. The other idea that's been put out there is also how they are really prioritizing yuan stability. And amid all this, there is a sense that we can expect limited easing from the PBOC to the extent that we have the likes of Bank of America saying that these yields on the short end, they're climbing enough that they're becoming increasingly attractive. So some things to keep in mind there, guys.
All right.
Avril? Avril, thank you so much. And just we actually have a report up on the terminal talking about Trump's red line vis-a-vis the China currency. If anyone wants to check that out regarding what Avril was just talking about. But President Trump's doubling of tariffs on China comes as the country's top political advisory body begins its week-long gathering. Bloomberg's China correspondent Min Lo joins us from Beijing. Well, an hour ago, we were having a different conversation, Min. We were talking about the likely response out of China to these tariffs. And of course, the response came at exactly the time that the tariffs got imposed on Chinese goods. China now saying that they will look to impose tariffs on some U.S. goods as well. What else do we know about the China response to the U.S. tariffs?
Yes, again, going exactly by the playbook, like clockwork. At 1 p.m., seconds after that, China released its slew of countermeasures, pretty extensive this time round compared to the previous round in February. They're targeting up to 15% tariffs on a list of U.S. goods. I'm just going to go through them very quickly. 10% on pork, beef, soybean, sorghum, fruits, vegetables, and dairy products. The one on soybean, of course, had been highly anticipated. And 15% tariffs on wheat, cotton, chicken and corn. So all of these are agricultural commodities. I would say that they are largely still less than proportional to the scale of the U.S. tariffs because we're talking about 10 to 15% tariffs from China versus 20% from Trump if you count in the first 10% plus the second round of 10%. And you look at the scale of it, the range of the goods covered. U.S. tariffs cover all Chinese goods, but the Chinese tariffs are targeting specific sectors, mainly the agricultural sector. So it's a clear message here. While it's impactful, but China is signaling that they are open to negotiation. That was as much what the NPC spokesperson said at the presser earlier, that they're hoping that they can resolve these trade issues through consultations. Now, aside from tariffs, China also targeted other non-tariff measures, including adding 10 firms to a U.S. unreliable entity list, as well as prohibiting the sale of dual-use items to 15 U.S. entities. And of course, one of their favorite methods, which is to file a complaint to the WTO as well. But again, very clear signal that from the NPC spokesperson that they believe that bilateral trade is win-win for both sides and they want to resolve this through negotiations.
Yeah, thanks for bringing the additional analysis to us, because we were trying to wrap our heads around the reaction in Asian markets today and the fact that a lot of these Asian indices have actually bounced back, a case of buy the rumor, sell the fact, and perhaps because the response was not as powerful as some people thought it was going to be. Just quickly, Min Min, how does this set us up for the NPC in the coming days?
Well, the NPC, I mean, of course, tomorrow is the government work report by Li Qiang that we are paying attention to, where he will outline the key economic targets for the year. We talked about that yesterday, the growth target, inflation target, and the stimulus measures. But again, as I mentioned, tariffs, the countermeasures has already been announced. What's next now is the negotiations, the back-channel communications, and that high-level talk that hasn't really happened. We're waiting to see how that would change the calculus when it comes to trade. But China is really focused on building the resilience of its domestic economy to boost domestic consumption to counter the risk of tariffs.
Bloomberg's China correspondent Min Min Lo in Beijing. Thank you so much.
Now let's turn back to the region here. The Johannesburg Stock Exchange has reported a more than 10% increase in net profit after tax and an improved return on equity of 20.2% for its 2024 financial year. Africa's largest bourse says the results show its diversification strategy is paying off. We're joined now by Johannesburg Stock Exchange CEO Leila Fourie. Leila, always great to speak with you. Thanks so much for joining us. I first want to start on this news before we get to the earnings from the JSE on what we're seeing with the Trump tariffs and get your insight into any concern that you may have that potentially this feeds into the investor confidence that we've seen here in South Africa revive and also South Africa's economic revival. Are you worried at all about that?
Jennifer, of course, uncertainty is never good for markets. However, the South African economy has proven to be reasonably resilient around the trade tariff situation, and particularly the US-South Africa situation. The Rand has held out well. Our stock market is up ahead of the NASDAQ. It's in line with the emerging market indices. So the exuberance and the positive perspective that investors have had post the establishment of the Government of National Unity appears to be holding out. The companies on the JSE are well capitalized. They have a good growth runway ahead of them, and our outlook is cautiously optimistic.
Cautiously optimistic. Talk about that, Leila. What is the caution that's feeding in to your outlook for 2025, especially when you consider what you saw in 2024?
So 2024 was a tale of two halves. The first half was deeply concerning and low levels of liquidity. The second half, post the Government of National Unity establishment after the general elections in South Africa, saw our both our all-share index top 40 surge and value traded also surged. So we ended the year up 9% on our all-share versus the MSCI Emerging Market Index, which was up 5%. We've continued to grow off the back of that. This year, our average daily value traded is up 45%, and our indices are up around 2%. So very much in line with emerging market indices. And while we are cautiously optimistic, because of the establishment of a coalition government, the coalition government has proven to be robust. It's proven to be very effective, and democracy is working in South Africa. So very different to some of the examples that you might see in the European environment like Germany and France. Growth is looking good. Our power security has improved remarkably, and the economy is on a good footing.
Leila, is your expectation then for the bourse that we'll see more IPOs? Last year, you told us the expectation was that we'd actually see 10 in 2024. That didn't necessarily pan out. What's your expectation for 2025?
Our expectation, again, is cautiously optimistic. It has improved. We did see 8 IPOs on the exchange. We've seen a surge in our bond listing space in the sustainability ESG space, up 133%, and in structured products. In the equity space, we are starting to see an increase in business confidence and an increase in growth prospects and capex cycles. So those are starting to open up and create a pathway for listings, but we are still cautiously optimistic. We're not out of the woods.
What does that mean, Leila? What does that mean though for the IPOs you expect?
We don't have a number of IPOs that we publish, but we do have a number of big IPOs that are in the pipeline, have been for some time. Companies like Canal Plus have signaled openly that they are considering secondary listing on the JSE. Coca-Cola has continued to consider a listing on the JSE, and we have a number of local companies. Of course, Anglo American will be unbundling Anglo Platinum in the middle of the year, and that should unlock shareholder value.
Okay, Leila, unfortunately, we have to leave it there. Busy day in news, but appreciate you and your time. That's the Johannesburg Stock Exchange CEO, Leila Fourie, joining us from Johannesburg. Now, coming up, Nedbank posts a record profit as fees fuel revenue growth. Its CEO, Jason Quinn, is joining us next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Nedbank's profit rose to a record after higher fees boosted revenue and lower credit losses reduced impairment charges. For more on the results, I'm pleased to say we're joined by CEO Jason Quinn. Jason, great to get you on. Nice to speak to you for the first time. Let's just start here. I was just speaking to Leila Fourie about the newly imposed tariffs on some of the countries globally. What's your expectation that this could feed into South Africa's economic revival?
Yeah, Jennifer, thanks very much, and great to be with you and all of your viewers here this morning. And thanks for the comments on our results. We're at Nedbank really pleased with our financial performance last year. We achieved the guidance that we set, and as you say, we grew in many areas. Look, I mean, all of us are kind of waking up every morning wondering what executive orders were signed at the moment. So we're not sure about tariffs and how that plays out. We think, unfortunately, tariffs may not be good for South Africa, particularly in some sectors like motors and others. But look, let's wait and see what happens there.
Let's get to your earnings then, Jason. We mentioned that the results met the average analyst estimate. What do you see as the key drivers for that? And given the uncertainty in 2025, how do you sustain that?
Yeah, thank you. So look, in 2024, we were really focused on a few things. Firstly, we had to get our loan loss rate or our bad debt charges back in line and back into our kind of target range. And that was probably our main battleground, and we got there nice and strongly. So we're well back within that range. And Jennifer, we think we can sustain that. But if you look at the sort of volume of our earnings growth, it actually came more from our non-interest revenue. So our fees and commissions, our trading income and the like. And I always think in a bank that is probably your highest quality earnings. In other words, it's a really good indicator of franchise health when you're able to sustainably grow your fees and commissions, because it implies you're gaining clients and implies you're serving them well. So that's a real positive for me. And as you say, into 2025, we've been pretty clear today in our guidance for what we think we can achieve this year. It's kind of more of the same. It's keeping our loan losses under control in our target range. It's growing our non-interest revenue. But Jennifer, we also said that the one area that probably the whole banking sector is going to disappoint in this set of results is our loan growth and deposit growth. We're not seeing that pick up. As Nedbank, we had targeted growth in a few areas. Like in our corporate and investment bank, we've got a great pipeline of loans ahead of us in renewable energy. We're doing really well in infrastructure, and we're very excited about public-private partnerships in that space as South Africa rebuilds its infrastructure. And in our retail business, we're quite excited about opportunities in vehicles and mortgage loan growth. But overall, system growth was pretty low. Rate cuts helped a bit coming into this year, and therefore we've kind of given guidance which indicates a little bit more of an improvement in that line into 2025.
Yeah. and unsure what that looks like for the rest of 2025. Jason, you mentioned the retail business. You mentioned in the SENS report, it says your retail and business banking, you're going through an organizational structure. Give us some insight into why this is happening and why now.
Yeah, thanks, Jennifer. So, it's an opportunity for us to center our client-facing businesses onto clients. So all we're really doing is segmenting our business according to the way clients engage with us. So in the past, we had a retail and business bank. Going forward, we're going to have a personal and private bank, which will serve customers right from entry level up through to wealthy. So we'll move our wealth clients in there as well. And then we're going to create a business and commercial bank. We see huge opportunity, in fact, in our markets around business and commercial banking. In fact, the growth in the economy that we do see is coming from that segment. And we've got a really nice franchise there. We just want to focus it and segment our product and distribution behind those sort of main segments going forward. So we'll get all that done. We'll do the transition in the second quarter, and we'll be live on 1 July.
Was that identifying, though, as well, some weakness potentially in the prior structure that you had?
I wouldn't necessarily say weakness, Jennifer. I think, in any organization, I think you want to see improved collaboration. And we kind of see this as an opportunity more than addressing a weakness in the past. It is fair to say, though, that at Nedbank, our retail and business bank hasn't generated the strongest returns in our organization. And we definitely see that as an opportunity going forward as we segment more towards our client-facing businesses.
All right. Well, we have to leave it there. We know it's a busy day for you. Nedbank CEO Jason Quinn joining us from Johannesburg. Jason, thanks so much for your time. Really appreciate it. Now, coming up, just days after his explosive meeting with Ukrainian President Volodymyr Zelensky, Donald Trump has now paused all military aid to Ukraine. The details on that next. This is Bloomberg.
Welcome back to Horizons Middle East and Africa. I'm Johanna Versace in Dubai. U.S. President Donald Trump has ordered a pause to all military aid to Ukraine, turning up the heat on Volodymyr Zelensky. This comes days after an Oval Office blow-up with the Ukrainian president, which left support from his country's most important ally in doubt. Joining us now is Greg Sullivan, Bloomberg's Russia economy and government editor. This feels like a major announcement out of the U.S. They're halting or pausing military assistance that goes towards Ukraine. What could reverse that decision?
Well, as you said, this is a very critical move. Trump is obviously ratcheting up the pressure. He's clearly unhappy with Zelensky after that testy White House exchange and the comments that the war might not end soon. But he might be after significant concessions. One could be forcing Zelensky back to the table to try to negotiate some sort of ceasefire. Zelensky obviously wants it on more favorable terms to Ukraine, but a concession on that front could help Trump reverse. And there's also the minerals deal. We know that Trump wants that deal, and it obviously did not happen on Friday. So potentially, he left the door open to it earlier, so that could be another pivotal move.
Yeah, I mean, we're coming off a weekend where many European leaders were trying to sort of reduce the temperature and the fraught nature of the exchange between President Trump and President Zelensky. What is Zelensky saying about his openness, not only to meet with Trump again, but also to potentially sign this minerals deal?
Well, he has said that he is open to signing the deal, and he said that he is open to meet with Trump again, but he did not apologize to Trump after the testy exchange. He said that he was willing to meet him for an equal dialogue, and that obviously didn't resonate well with Trump. And then, of course, you had his comments that the end to the war was still a long ways off, which Trump publicly responded to. So even though he is saying he is willing to meet with Trump, he's obviously not saying it in quite a way that Trump has been receptive to, even with the European efforts to try and re-engage the two individuals.
Yeah, I mean, it's a big issue. And actually, markets are very quick to react. I was just noting now that some of Asia's defense stocks have been rallying today after this announcement came through, again, in line with the price action that we've had in European defense stocks. Greg Sullivan, thank you so much. Bloomberg's Russia economy and government editor. So keeping a close eye on geopolitical developments and the impact that that's having on some stock markets, defense stocks clearly in focus. But the major story today is all about tariffs and the fact that those tariffs on Canada, Mexico, and China have gone into effect about an hour ago now. So it's actually happened. Despite that, S&P futures, NASDAQ, Dow, all leaning towards the green. Asian stocks have rebounded from some earlier losses. Euro stocks futures, however, the only little bit of red that you can see on the screen, down 0.75% as we head into the European session. So really big day for markets, big day for anyone watching all the tariffs news. That is it for Horizons Middle East and Africa. I'm Johanna Versace in Dubai with Jennifer Zabazaja in Johannesburg. Stay with us for Daybreak Europe.